So hello, and I welcome you to today's Trading Spotlight webinar here on Friday, the 22nd of November 2019. My name is Klatt, and I'll be the moderator here for the upcoming, something like 45 minutes. And today we want to look at something which is probably especially at first glance, definitely interesting for mathematicians. Here we want to answer the question how to use fractals in your trading, or what you can do, how you can apply fractals in your trading. In fact, so this is especially interesting for mathematicians, and we want to give you an idea on this concept here. Or I want to try to give you an idea on this, and then show you also how to apply this knowledge then to trading in general. So in this context, let's have a look here at today's agenda. Before we start, first of all, then with an introduction, especially from Admiral Markets, who makes all this here possible with the webinars, the Trading Spotlight series. So the questions we want to answer today are, what are fractals? How can fractals be applied to trading? And then we want to give also fractal trading examples, and at the end, a short summary of what we just talked about. So well, my name is Jens, so I think I already introduced myself. Some of you probably have already listened to several other Trading Spotlight webinars, have seen the recordings on the YouTube channel from Admiral Markets. And I, in fact, don't want to go into too many details here in regards to my... Okay, yeah, I can already read here in the chat box. Vincenzo is writing, "I love Williams fractals." So perfect, that's great. So then you already heard about this topic. In fact, yes. So in regards to my person, I'm located in Berlin, in Germany, yeah, this is probably the most interesting thing, and in fact, or not probably the most interesting thing about my person, but something which I want to focus on here, and like to here come over to Admiral Markets, a broker which offers over 8,000 financial instruments. The FX CFD business here is in the industry for, you can see it here, 18 years right now. And has now offices in over 20 countries around the globe, one in Germany, and the one in Germany is here in Berlin. And so I have a direct connection to the guys here from Admiral Markets. And that's why I refer to this. What's even more interesting and even more important is that Admiral Markets is, I think it's fair to say, to consider Admiral Markets to be a global player. And not only a global player due to the more than 20 offices around the globe here, but also in regards to the greatness. So in general, when it comes to the company and the offering and the highly competitive offering, the fact that they're located not only in over 20 countries, but also fully regulated here from the FCA, for example, also in Europe, and from the CISEC. Brexit is a topic in this regard, sure, but also, for example, from ASIC in Australia. And why do I mention this? It's very, very important, not only that you are trading with a regulated broker, which you will find when trading with Admiral Markets, but also when you're listening here to this webinar in English, but your native language is probably a different one, you have a very good chance then to reach out to someone in the customer support here at Admiral, which is talking in your native language. And I think this is also a definite plus here for traders. And yeah, so that's it around Admiral Markets. So we now want to focus on the question, what are fractals, in fact, and give an idea on the basics behind, or what it is, in fact, and then take it from there and have a look at how to apply this to trading. So in mathematics, fractals are defined as a subset of Euclidean space for which the Hausdorff dimension strictly exceeds the topological dimension. I mean, this it's quite clear to everyone, I think, listening to this right here. So what I can say is that Hausdorff dimensions and everything has been a topic during my studies. In fact, when it came to algebra, and I can say that was a kind of difficult topic to understand in depth. In fact, and but you will see that sounds very, very academic here. It's not that difficult, in fact, but it's in fact very exciting and spectacular topic. So what's special about fractals is that they tend to appear nearly the same at different levels and exhibit similar patterns at increasingly small scales called self-similarity. So you probably have seen something like a fractal already in the nature. For example, when looking at snowflakes, and it doesn't really matter if you zoom into this snowflake, for example, it doesn't matter how big the snowflake is. It is self-similar. So it looks very, very similar to the same, and it doesn't really matter how great the zoom is then you use, or respectively how big, how small this snowflake is, for example, just to give just an idea. And so fractal geometry here uses iteration and not as classical geometry formulas to define shape. So what they do is, in fact, they have an initial shape, and then they put a function on this initial shape. They get a fractal shape. They put a function, the same one, again on this one. They get another fractal shape, and then they repeat and repeat and repeat and repeat. So very interesting, in fact, but how can this help in trading? Respectively, not really how can this help in trading, but what's probably even more interesting is what can we, how can we make this somehow, can we express this? Can we have a picture to that? And yes, we can. So to give you an idea on these fractals, we click here. And there you can see the source, by the way. It's a very, very great source, in fact. It's a blog article. And you can see it already in the URL here. You can see what are fractals and why should I care, in fact. So we will see how to apply this concept to trading. It's not trading related, but it's something which will become very, very clear. So what we have here is and there you can see it. So to some extent, you can already see it right here. This looks very, very similar to a snowflake at the end, at least here. So, and what we do is, in fact, we start with this line here. So this is the initial shape I was talking about. And then we put a function on that. Let's say we the function says divide this line in 3 parts, and each of them has to be equal here, from equal length in this case. Okay, so now you see that you can put these lines up here, and then you get this one in the middle. Okay, you have from initially 1, you're going to 1, 2, 3, 4 lines then. Okay, from 3 you go to 4 third. It's this is too complicated, but let's put it that way. So you use this middle piece here, and you get this spike in the middle. Okay, and then you do the same again. You use the same function again, and you divide this one, this one, this one, and this one here, all these 3 lines again in thirds, and then you put in these spikes here once again. Okay, and now I stop by doing that, but you do this again. So you put in those this function again here, and then you have again the spike here, and then you have the spike there, you have the spike there, and you do this over and over and over again, and you repeat it, repeat it, repeat it. And the interesting thing now is, if you do this over and over again, you get something which, and there the snowflakes comes into play again, which looks like nature. So you can already see it. To some extent, this is a pattern you probably may have seen, or at least you think you have seen it somewhere in nature. And here a guy now comes into play. His name is Benoit Mandelbrot, and he's a very, very famous mathematician who introduced this topic of fractals here also to the world of finance. And I will recommend you a book in a few seconds. But first of all, let's have a look here at this famous Mandelbrot set, or Mandelbrot set. I don't know how to refer to him here in English. And probably you have seen this somewhere, okay? And you can also see here that this set also consists of a structure similar to the one which we just created, in fact. And so I already mentioned this fractal geometry here looks like nature, or the question is, doesn't it look like nature at first place? And I think the answer is clearly yes. So somewhere you can imagine this to appear somewhere in the real world, or nature, in fact. And now our idea is, since in nature there are no such things as perfect cycles, for example, so you don't get a cycle which is completely round, in fact, but this has also to do with the fact that we're talking about p and it's an irrational number and everything. But the thing is, there is no such thing as a perfect cycle or something. Nature is not perfect. And this means that fractal geometry then can model natural phenomena here with a higher accuracy than classical geometry, and thus is interesting for us as traders, because day to day in our business, when looking at charts, for example, or looking at patterns you may see in the chart, they are also not perfect. In fact, the same is true when it comes, for example, to calculate risk. So we know that, for example, markets are not normally distributed, for example. So, for example, how can I say that? Risk models like value at risk, for example. This is an idea where you say, to give an idea, let's say you have a value at risk of 10, let's say, okay, value at risk of 10. That means that in 1 out of 20 months, your strategy, your trading with a value risk of 10 is gaining or losing, and then we focus mainly on the losing side. We are losing 10% or more than that, okay? Statistically, 1 out of 20. That doesn't mean that this will happen only once in 20, but if you do it often enough, you probably will have it 3-4 times happening that you're losing 10% or more with the strategy. It means also, on the other hand, that you have a chance of gaining 10% and more in 1 out of 20 from a pure statistical standpoint, for example. But the real world is not such or the real trading world is not such a place where this happens, and that was one of the main problems, for example, during the financial crisis, and also why so many investment banks suffered, respectively Lehman Brothers went down. Their risk models were based on theoretical assumptions which can't be found in the real world, and this is something which is very, very interesting then, and which was taken then from Mandelbrot here to apply these fractal geometry to the world of finance, in fact. And I already prepared, let me just see, I think I have it here. Yes, there we have it. So the book is called The Misbehavior of Markets, a Fractal View of Risk, Ruin, and Reward. And I will just copy it here into the chat box. It's very interesting, by the way, what Vincenzo just wrote here in the chat box. Probably you can see this. I'm not really sure, but also, for example, Elliott waves. They are also a fractal structure. So you can find the chat in the chat box now. The link. If you're watching the recording, just check the description box below the video, and there you have also the link to this book. Then, in fact, by the way, just to give you an idea, this is how the books. How this book here looks in German. So there it's not a misbehavior of markets, but it's Fraktale und Finanzen, so fractals and finance, in fact. But it's the same book, only in German. So yeah, let's come back here to the presentation. 1 second, let me just see. I have it here. So now what we want to do is we want to use this knowledge, and apply it to trading. And the question is, how can fractals be applied to trading? In fact, a very, very interesting one. So let's start with the first bullet point here. So first of all, price movements in trading appear to be random. Something we I think all agree on, or we can definitely agree on. We can't say whether the next tick is up or down. Sure, we can somehow, with some experience and also analytical methods, identify a higher likelihood of one thing happening over something else. So if it's going up or down, but at the end of the day, we can't be certain whether it will go up or down. The market will go up and down or down. But it's fair enough to assume that markets charts are built up from self-similar patterns of traders' behavior. This is very interesting, right? So we already discussed about topics like psychological aspects in trading, something like loss aversion. We have seen charts here within this Trading Spotlight series where you can see that, for example, loss aversion, so overweighting loss in your trading, is a natural phenomenon in trading, in fact, and is something we humans have naturally within us. Okay, and so based on that, it's fair to assume then that we say, okay, based on the knowledge that this is naturally within us, this behavior and these psychological patterns, that markets then tend, for example, to create patterns over and over again and repeat them over time, in fact. So it's something you can see it here. So loss aversion is human and thus results in repetition of many traders over and over again. So in fact, fading the momentum, or overall, we can put this simply and say they are trending against the trend, in fact. So cutting winning trades short while letting losing trades run. Okay, and this is the classic human behavior here, called loss aversion, which is likely to repeat itself over time due to the fact it's human, and thus results in self-similar patterns being produced within the chart. Then, so. And the initial assumption then on fractals from Bill Williams is that a fractal pattern consists of a minimum of 5 consecutive bars, which have a middle bar that has a higher high or a lower low compared with the 2 preceding and the 2 following bars then. And based on that, you can assume that one thing is more certain to happen over the other, for example, and apply this then to your trading. So here I have a chart, and there you can see how this in fact looks like. It's a very, very simple concept. It's not that it's rocket science or something. Definitely not. We can definitely say that. It's very, very simple. And here you can see that. So you have the market, for example, building a structure of in this case, it's white candles or green candles. So market's going up, and then the market is not penetrating or going higher than the former high, but instead reverses here and trades lower. And the idea now is to say, okay, once the market goes above that former high, use this here to trade then in direction of the initial momentum, in fact. And the same is true also on the downside in this case. So you can see it here. You have candles, a downtrend. There you can have this, let's call it a V here. And then once the market now goes below that former low, the structure is forthwritten on the downside. It's a simple approach, in fact. Now you might probably wonder where to get these these V's from, if you can use them. And in fact, they are within the MetaTrader 4, respectively the MetaTrader 5 trading platform. So you can what's the word for this? You can show them within the chart by going to the top. Then, unfortunately, I haven't the MetaTrader open right now. That has a resource-wise, or it's a resource-wise problem. So, because if I have the MT4, MT5 open, I probably have some trouble here to run the webinar in such a smooth way, in such a smooth fashion here. And so I closed the MT4, MT5 platform. But if you have it open right now, probably just check the tab insert at the top of it, and insert here an indicator, and go down to custom, and there you scroll as low as to F, and there you will see fractals, and there you can put these fractals, these V's here. Those let's call it the V, okay? But it's a sign you then see displayed in your chart, in fact. So it's insert, you go to the indicators tab, and there to custom, and there you find it under F, under fractals. Okay, so then you can apply to your chart then that way. And now we want to look here at some examples, or at not really right now with the chart, but first of all, we start with some parameters, and we always use them then to put them on the chart. So we will use fractals, the fractals indicator in MT5, as I already described. And then we have our trading rules. So very simple. We say we trade in direction of the fractal signal after a fractal start, but only if the market subsequently resumes in the signal direction and then breaks beyond the level of the fractal signal, depending on the up or on the downside. And then we place the stop loss to close this trade guided by the level of the so-called fractal stop, in fact. Okay, and this is all. These are the only 2 points we want to follow here. So to give you a picture of that, you can see it here. So we have a fractal to start, and there you can see it. We have here in this case, this is 2 candles going down. Okay, so these 2 are obviously it's a downward sequence. There you make a new low. This is where you have the fractal signal, and then you have 2 candles going up. In fact, overcoming the initial fractal here in this case, but this is we can ignore that. So in fact, what we could also do is we have a signal here on the short side once we go below that level, or we could also say if we go above that level, so when starting from the fractal here, then we have a long signal, in fact. So you go 2 candles lower, and if we now trade higher again from here, then you have the buying signal, in fact. So, but in this case, the market then has here the lower forthrights, this sequence here, then of falling highs and falling lows in this case, and you have the signal being generated once the market breaks below here, this so-called fractal signal in this case, while you place your stop then above the high of this pattern. Yeah, let's call it a pattern. So you place the stop here in this case, and so this is how you enter the market. Now it depends, in fact, on how you exit the market in the long term. So I haven't made an exit strategy now a topic here. But one thing could be to wait until a counter signal is generated. That means in this case, so you have a next fractal signal being generated here, but we are already short, and then you see the market pushing back here in this case. And if now this high here, the market has this new fractal signal being generated, if a long signal then is generated here, then you would take out the trade. That would mean a loss of, in this case, the entry price here to that point, because the market then starts to present itself in a, let's call it, choppy mode, as it does right now, for example, when looking at the DAX, and a very erratic behavior. But all in all, we can definitely say, all in all, that this is a very, very good way to enter an existing trend, because you can also be sure if the market continues to trend lower, as it does obviously here, well, then you can see that you will most likely stay at, especially in a strong trend which develops after that. So if the market then, for example, here goes lower again, as it does here, and then starts to generate such a signal here, such a buying signal again, then this would be the moment when you where you place your stop, in fact, where you would trail your stop to this level, in fact. So that would mean then that you're nearly here at the so-called break-even level already. So you entered the market here, and then you're taking the out the trade out once it's once this high here is penetrated, which is happening here, in fact, and then you're stopped out on this trade. But as you can already see, this small snapshot here, this is also nothing I'd consider to be a really strong trend. So you would probably find a way more attractive setup in a strong trending environment, in fact. Yeah, and that's in fact it on this topic. It's nothing really spectacular, in fact. The most spectacular thing is probably on fractals itself, and how they are, let's call it, created in nature, how they appear in nature, and based on that, the mathematical approach behind that, and then how to apply this this idea here. Let's go probably back here to this point here, the initial assumption of fractals from Bill Williams is that a fractal pattern consists of a minimum of 5 consecutive bars, and this is repeating itself. So very similar also when it comes to Elliott waves, for example. Let me just see whether I can find, yeah, there we have it. Let me just make this here that way. So I'm not an expert on Elliott waves, by the way. So probably Marcus, probably especially Paul, are better experts on that topic. But I just want to give you, based on my knowledge in regards to Elliott waves, some thoughts how these fractals could be applied to this topic. In fact, so it will be really rough. But so what we know is that based on Elliott wave theory, there is also a sequence here of 5 waves. Okay, let's start with that. So you have, this is the first wave, you have a second wave here, then you have a third wave here, you have a fourth wave here, and then you have a fifth wave. Okay, so that's the impulse, and then the market corrects. That's most of the time like an ABC. Okay, that wasn't really good. 1 second, I have to, it's like an ABC. Okay, so call this A, call this B and C, and then we take it here from there again. 1, 2, 3, 4, 5. Okay, and this is how a trend develops. In fact, so very roughly said. Okay, so I'm not talking about A, B, C, D, E, and all these potential alternations and everything like that. But that's just to give you a basic idea on that. And so what happens now is that Elliott waves say this is happening over and over again. So you have the impulse, you have the corrective move, then you have the impulse again. And this is also something we can refer to as a fractal, because it's not only happening on daily chart, but let's call it D1 here. But you can also see this if you break it down to H1, if you break it down to a 50-minute chart, for example, you can see this pattern here the same way. So 5 impulses, you have five waves up, you have a corrective move ABC, 5 ups again, and the way a trend develops, in fact, over time. And then these developments here from D1, H1, 50-minute chart, 5-minute chart, whatever, they are self-similar also. And now there's some things to also recall where this concept becomes quite interesting, let's say. So it's that they say, for example, that wave 1, for example, is as long as wave 5, or similar. It's very similar. Wave 1 is similar to wave 5 when it comes to the length of the wave, for example. Also, what happens is that this this move lower here, this wave 2, is usually something, most of the time, let's say, that we have a so-called zigzag, which means we have also here this pattern where we go down that way. So with such an ABC, and we remember, okay, the ABC happened already also here before, at the end of the trend. So this is also where the self-similarity comes into play. And if this, for example, happens here, then wave 4, the next potential corrective wave, is something Elliott wave theorists refer to, if I'm not mistaken, as a flat. So which means this alternates. Then if you have a zigzag here, you usually have a flat here within this. So this is also something other technical analysts probably would refer to as a so-called flag or something. And then there's also something happening here. So if this is wave 4 and this is wave 2, then we have obviously 3 here and we have 5 here. So if we assume that 1 is similar, or in this case here is similar to 5, there's also saying that or a rule which says that wave 3 is in this case the longest one, and it's not allowed to be the shortest one, for example. So, and then there's something which comes into play, yeah, that's called Fibonacci's, I think, we can use here in this case. So if we say that you have 1, the wave in this case, and 1 second. So, and then you can multiply wave 1 with a FIBO projection. Let's assume it's 1.68 618, for example. This is then how you get wave 3. Okay, and this is then the length of this wave, for example, and this happens over and over again. So this is just some basics, and I hope that purists on Elliott wave theory are not going after me after that, because they say, okay, this wasn't really right, or that's completely you have to extend this. You can't just say this is that way around or something. I'm not an expert on Elliott waves, but what I know is that Elliott waves are based on the principle of fractals. And this sequence here of, for example, a 5-wave impulse and ABC corrective move, this is something where you can also use the thoughts on fractals based on, okay? So that you can say, okay, if you have, for example, here such an ABC, this is something we refer to as zigzag. Within this, it's a corrective move, and based on that, we can say, okay, ABC is also something which you can see then as a correction in a higher time frame. Then, for example, if you look here at the daily chart, you say, okay, then it appears, for example, on a weekly chart. So one second, let me just see the questions. Yeah, for example, everything like this, and there's also a book on that I highly recommend. It's called, I think it's only Elliott waves from Prechter, I think. Bobby Prechter, but one second, let me just see. I'll just see, I think it's Robert Prechter, Elliott, probably, that's... Yeah, Elliott wave principle. This is a key to market behavior in this case. So also something which is probably of interest then, if someone now says, oh, cool, Elliott waves is something I'd like to get some thoughts on. It's definitely, even if you do not plan to use it within your trading and trade based on this concept, it's great to understand how market behave, in fact, or how a structure of a market could look like, in fact. And with this knowledge, you probably have a better feeling of when, for example, a trade based on another completely different approach, like a breakout approach. In my case, for example, I'm more of a breakout trader and breakout strategies. I still, when trading this in the on an intraday time frame, I still look at the higher time frame, and here on the most like based on market behavior, respectively, not necessarily on Elliott wave, but on something like Dow theory, for example. I analyze the market, and I also try to get an idea, to grasp an idea of where do we stand right now. Is it favorable to be in the long position here, or is it probably difficult from a risk-reward perspective? Probably also something which is also very interesting. Let's come back to another concept. So this is not Dow. I'm sorry, this is not Elliott waves then anymore, but this is something also based on on human behavior, in fact, something which also probably can be sometimes found in markets, is based on fractals. So when I say, where do we stand in the market? Let's assume the following. Let's say we have a sequence here of higher highs and higher lows. So we are an uptrend. So long positions are to be favored. And now what I do is I usually say, okay, I have... Let me probably put it a little wider. So let's make this bigger and green. And then we can also have it here. Let's call, and then make this red. So why do I do this? Well, the reason is simple. As long as we are trading here within this green rectangle, I consider the risk reward for long engagements to be attractive. And I refer to this area usually as something I call accumulation area. Accumulation. Oh, moment. 1 second. This is right. Accumulation area. 1 second. And I have to make this green. Okay, so this is my accumulation area. This is where I expect big market participants to accumulate, to add to their position. And why do they do that? Because they know, first of all, if they wait for the break to happen here and this sequence from higher highs and higher lows to be forthwritten with a break higher, they definitely run into trouble here. Why do they run into trouble? I think very simple, because everyone can see this former high. And this is once the market forthrights the sequence of higher highs and higher lows, which means nothing more that everyone, let's put it that way, okay, in quotation marks, but everyone wants to buy here, and it's a level of high interest for market participants. And once you have to fight here for the best execution price, and you know that somehow everyone wants to buy in that area, you could get trouble, especially if you're trading bigger volume here. You have no real chance to get all the material, let's call it, all the shares, for example, or all the currency you want to buy, the amount you have to buy here for a client, for example, for your own portfolio, whatever. You have trouble here. So what you usually do is then, as a professional, you try to anticipate such a break, and you're already positioned before the break happens, in fact. And you do this during times of low market volatility, and you do this during times when most market participants are skeptical whether the market can really break higher or not. So where market participants, some, especially retail traders, think, okay, probably this is the big deal here with this retracement. So now I try to anticipate a move which is going that way, and that's why I'm shorting here, even though I can see that there's still a sequence of higher highs and higher lows, and this sequence stays intact as long as we trade above this former relative low here. That based on that, they short, and at the other hand, and on the other side of the trade, are the big institutional guys, well-informed traders, who see also the still intact sequence of higher highs and higher lows, and that's where they buy their stuff from, bit by bit, but still they accumulate. That's why I call this accumulation area. So, and if the market then breaks out here into the red part, now the second reason why a professional trader does not want to buy here is it's not only because here it's difficult to say to buy in regards to strong market moves and markets taking on momentum, but also, even probably more important, this is the area where, first of all, the guys who bought here start to sell their positions again for a profit, but also from a risk-reward perspective, it's not very attractive, because the higher the market moves here, the more unlikely more and more people will now jump on that wagon here and try to catch the trend. But in fact, they probably will wait for a corrective move to happen. And the more market participants are becoming skeptical if the market can rise any higher, the higher the likelihood that the market will rather sooner than later show a corrective move. I'm not saying we're breaking the trend here, but we see at least a corrective move because buyers are not stepping in the ring anymore. And this is why I call this area, where do we have it here, why I call this area then the so-called distribution area. Because here is where the institutional guys try to distribute their accumulated shares, stocks, and or currencies, whatever, commodities. They distribute what they just bought here. It's especially true for so-called progression traders. These are the traders who are not trading the trend, but only here the progressive move then in direction of the overall momentum. And that's very interesting because they started to buy within this region here somewhere, and then they start to sell step and bit by bit higher here. So this is the pure theory behind this, and that's what I mean when I say it's probably worth to know this concept and to know why markets behave in one or the other direction. And it's not only true to price action trading or to Dow theory, but also to Elliott waves, for example, because the psychology behind this is moving markets here in this regard. it's not necessary to trade based on that, but what's probably good is to have this knowledge here and then build your trading decision based on that, and also apply this knowledge then to other trading approaches like breakout trading on the lower time frames. So okay, that's it in regards to some thoughts on top of fractals and how to use it and Elliott waves and everything based on that. And now let's come to the summary then. So here we have once again this example. Now let's have a look here at the summary. So fractal geometry can model natural phenomena with a higher accuracy than classical geometry. This is not only true when it comes to price action, this is also true when it comes to risk evaluation and everything. Something what Mandelbrot focuses on in his book, I recommend it. Fractals, just to keep this in mind, are self-similar. If you look at a small section of the pattern, it is no different to a much larger section of the pattern, or even the whole, in fact, which means smaller time frames can be adapted to a larger time frame and vice versa. So the knowledge you apply to a lower time frame 5-minute chart is the same you use then on a daily chart. Just probably the difference is that the impact the developments on the higher time frame has, based on the fact that we're talking about bigger volume, which is traded on a daily time frame instead on a 5-minute candle, is bigger here in this case. So, and yeah, fractals trading here aims to align you with the trend. That was what I tried to emphasize also here, to make sure that you understand you can stay within the trend based on fractals, especially during strong trends developing, because it's very unlikely that you're seeing a so-called counter trend being initiated, or such a initial position being turned around there, or yeah. With the fractals indicator, so trading signals and setups can be quickly formulated based on fractals, and this is what all this aims to do, align you with the trend. So it helps you to position yourself with an existing trend here and stay within the trend till this trend bends. So now, don't forget to join us next time. So it's Friday. I wish you, first of all, I wish you a nice weekend here, and enjoy yourself. But already have in mind that on Monday, I'm sorry, no, it's not Wednesday. Let me just think about this. I think it's not Wednesday. It's Monday. I think it should be Monday. I think so, yes. It should be, because Wednesday is Marcus Day. So I think this is just the wrong word. This is not Wednesday, it's Monday. So on Monday, Paul will help you to learn more about a versatile swing trading strategy, part 2. So we started last week already with part 1, or this week in this case. So with part 1. And here, the questions he wants to answer, then how to build on part 1, how to improve your trading method, and where are the best opportunities, in fact. So when 2 p.m. London time, or 2 p.m. GMT, however you put it, it's the 25th of November. There you can see it. It has to be Monday, because Monday is the 25th. So forget Wednesday, it's Monday. Check your inbox for the webinar link. All those right now being here, check the inbox, because check the inbox for the link you're getting sent. If you watch this right now on YouTube, if you just enjoyed what you've seen, please leave us, first of all, a thumb up, and also here don't forget to go to admiralmarkets.com. And there, under education, you can register for the webinar. It's for free. You can register under Trading Spotlight then. And if you register once, it's a recurring webinar, then you're registered for all the upcoming webinars. In fact, it's not only me, but it's also Paul on Monday and Marcus then on Wednesday. So here's the website, admiralmarkets.com. And if you want to contact Admiral, feel free to send an email. Watch also here the YouTube channel, or for all those watching this right now. Also, if you're on Facebook, we have a Facebook Admiral Markets community. And as I already mentioned at the beginning, but we have to finish with that, the risk disclaimer because of the regulation. And yeah, I hope you enjoyed the webinar. I wish you a nice weekend. Enjoy yourself. Talk to you again next week on Friday. Then we want to get an idea on how to prepare for the next potential financial crisis which could hit the markets, how to prepare for such a crash, and how to bring your portfolio or make your portfolio a safer place probably. And that's it from mine. So all the best. Talk to you soon. Bye bye.